I've summed up my 5 takeaways and thoughts about this book in this video. I highly recommend you to read the original book of the author. Please share with me your opinion about this book in the comments below. All About Market Indicators by Michael Sincere is a comprehensive guidebook that provides readers with a detailed overview of the various indicators that are used to predict market trends. The book is a valuable resource for anyone interested in understanding the stock market and its workings. The book is divided into 3 main parts. Part 1 is an introduction that covers the basics of market indicators, including their definitions, how they work, and their strengths and limitations. Part 2 delves deeper into the most commonly used indicators, such as moving averages, relative strength index, and Bollinger Bands, among others. Sincere explains each of these indicators in detail, including how to calculate them and interpret their signals. Part 3 of the book provides readers with a practical application of the indicators. This section includes several case studies that demonstrate how the indicators work in real-life situations. Readers will learn how to use the indicators to develop trading strategies and make informed investment decisions. One of the strengths of the book is its clarity of writing. Sincere has a talent for explaining complex topics in simple terms. He uses real-world examples and analogies to illustrate his points, making it easy for readers to follow along. Additionally, the book is well organized, with each chapter building on the previous one, and a glossary at the end to help readers understand key terms. All About Market Indicators is a must-read for anyone looking to invest in the stock market. Whether you are a novice investor or an experienced trader, this book provides valuable insights that will help you navigate the ups and downs of the market. By understanding how indicators work and how to interpret their signals, you can make informed investment decisions and increase your chances of success. Market indicators are tools used by investors to analyze the stock market and predict future trends. They are based on market data, such as price and volume, and can help investors make informed decisions about buying and selling stocks. By analyzing market indicators, investors can identify patterns and trends that may indicate a stock's future direction. Market indicators are essential for investors because they provide valuable information about the stock market. Without them, investors would be trading blindly and would not have a clear understanding of market trends. Market indicators are especially important for technical analysts, who rely heavily on data to make investment decisions. However, it is important to note that market indicators are not foolproof. They are based on historical data and are not always accurate predictors of future trends. Investors should not rely solely on market indicators to make investment decisions, but should also consider other factors, such as the company's financial health, the overall market conditions, and news and events that may impact the stock's performance. In conclusion, market indicators are valuable tools for investors, but they should be used in conjunction with other forms of analysis to make informed investment decisions. By understanding how market indicators work and how to interpret their signals, investors can increase their chances of success in the stock market. Moving averages are a type of market indicator that investors use to identify the trend of a stock's price over a given period of time. The moving average is calculated by taking the average price of a stock over a specific time period, such as 50 days or 200 days. Moving averages are a popular indicator because they are simple to calculate and easy to understand. They are also versatile and can be used for both short-term and long-term analysis. Investors use moving averages to identify trends in a stock's price, such as an uptrend or downtrend. When the stock's price is above its moving average, it is considered to be in an uptrend, and when the stock's price is below its moving average, it is considered to be in a downtrend. One common strategy that investors use with moving averages is the crossover strategy. This strategy involves using 2 moving averages with different time periods, such as a 50-day moving average and a 200-day moving average. When the shorter-term moving average crosses above the longer-term moving average, it is considered to be a bullish signal, and investors may look to buy the stock. When the shorter-term moving average crosses below the longer-term moving average, it is considered to be a bearish signal, and investors may look to sell the stock. It is important to note that moving averages are not perfect indicators and can provide false signals. They are based on historical data and may not always be accurate predictors of future trends. Investors should use moving averages in conjunction with other forms of analysis to make informed investment decisions. Additionally, moving averages should be used with caution in volatile markets, where the stock's price may fluctuate widely and quickly. The Relative Strength Index, RSI, is a popular technical indicator that is used to measure the strength of a stock's price relative to its previous price movements. The RSI is calculated using a formula that takes into account the number of days a stock has closed higher versus the number of days it has closed lower. The RSI ranges from 0 to 100, with readings above 70 indicating that a stock may be overbought and due for a price correction, and readings below 30 indicating that a stock may be oversold and due for a price rebound. The RSI can also be used to identify divergences, where the stock's price and RSI are moving in opposite directions, which may indicate a potential trend reversal. One common strategy that investors use with the RSI is to look for bullish or bearish divergences. A bullish divergence occurs when the stock's price is making lower lows, but the RSI is making higher lows. This may indicate that the stock's price is due for a rebound. A bearish divergence occurs when the stock's price is making higher highs, but the RSI is making lower highs. This may indicate that the stock's price is due for a correction. It is important to note that the RSI is not a perfect indicator and can provide false signals. Like all technical indicators, it is based on historical data and may not always be accurate predictors of future trends. Investors should use the RSI in conjunction with other forms of analysis to make informed investment decisions. Additionally, the RSI should be used with caution in volatile markets, where the stock's price may fluctuate widely and quickly. Bollinger Bands are a type of market indicator that is used to measure a stock's volatility and identify when it is likely to experience a significant price move. The Bollinger Bands consist of 3 lines: a middle line, which is a simple moving average, and 2 outer bands, which are based on the standard deviation of the stock's price over a given time period. The outer bands are typically set 2 standard deviations away from the middle line. As the stock's price moves closer to the outer bands, it is considered to be more volatile, and investors may expect a significant price move. When the stock's price moves outside the outer bands, it is considered to be a strong signal that the stock may be overbought or oversold, and investors may look to buy or sell the stock. One common strategy that investors use with Bollinger Bands is to look for a squeeze. A squeeze occurs when the outer bands move closer together, indicating that the stock's volatility is decreasing. When the outer bands break out of the squeeze, it may indicate that the stock is due for a significant price move. It is important to note that Bollinger Bands are not perfect indicators and can provide false signals. They are based on historical data and may not always be accurate predictors of future trends. Investors should use Bollinger Bands in conjunction with other forms of analysis to make informed investment decisions. Additionally, Bollinger Bands should be used with caution in volatile markets, where the stock's price may fluctuate widely and quickly. The book All About Market Indicators provides practical examples and case studies that demonstrate how market indicators work in real-life situations. By showing readers how to apply market indicators to actual stocks and market conditions, the book helps readers develop a deeper understanding of how market indicators work and how they can be used to make investment decisions. The case studies in the book cover a wide range of market conditions and stock types, from individual stocks to market indices. The examples demonstrate how market indicators can be used for both short-term and long-term analysis, and they show how different indicators can be combined to create a comprehensive analysis. The case studies also highlight the importance of risk management in investing. By showing readers how to use market indicators to manage risk and limit potential losses, the book provides readers with practical tools for protecting their investments. In addition to the case studies, the book also includes charts and graphs that illustrate how market indicators are calculated and how they are used to identify trends and patterns in the market. These visual aids help readers understand the concepts more clearly and make it easier for them to apply the principles in their own investing. Overall, the practical examples and case studies in All About Market Indicators help readers develop a deeper understanding of market indicators and how they can be used to make informed investment decisions. The book provides readers with valuable tools for analyzing the stock market and managing risk, which can help them increase their chances of success in the market. While market indicators can provide valuable information about the stock market, investors should not rely solely on indicators to make investment decisions. There are several other factors that investors should consider when making investment decisions, including the company's financial health, overall market conditions, and news and events that may impact the stock's performance. Fundamental analysis is one approach that investors use to assess a company's financial health. This involves looking at the company's financial statements, including its balance sheet, income statement, and cash flow statement, to evaluate its earnings, assets, and liabilities. By analyzing the company's financial health, investors can determine whether it is a good investment opportunity. Another approach that investors use is technical analysis, which is the study of market data, such as price and volume, to identify patterns and make investment decisions. Technical analysis can be used to identify trends and momentum in a stock's price, which can help investors make informed decisions about buying and selling stocks. Investors should also consider overall market conditions when making investment decisions. The stock market is influenced by a variety of factors, including the economy, interest rates, and geopolitical events. By understanding the broader market trends, investors can better assess the potential risks and rewards of investing in a particular stock. Lastly, news and events can have a significant impact on a stock's performance. This can include company-specific news, such as earnings reports or product launches, as well as broader news events, such as changes in government policies or major economic shifts. Investors should stay informed about these events and how they may impact the stocks they are considering investing in. In conclusion, while market indicators can provide valuable information about the stock market, investors should not rely solely on indicators to make investment decisions. By considering a variety of factors, including fundamental analysis, technical analysis, overall market conditions, and news and events, investors can make informed investment decisions and increase their chances of success in the market. Technical analysis is a popular approach that investors use to study market data, such as price and volume, to identify patterns and make investment decisions. The goal of technical analysis is to predict future price movements based on past performance. Technical analysts believe that market trends and patterns repeat themselves over time, and by studying historical data, they can identify these patterns and make informed investment decisions. One common technique used in technical analysis is charting. Charting involves plotting the stock's price over time and looking for patterns in the data. Technical analysts use a variety of chart types, including line charts, bar charts, and candlestick charts, to visualize the data and identify patterns. Another technique used in technical analysis is the use of indicators, such as moving averages, Bollinger Bands, and the Relative Strength Index, RSI. These indicators help investors identify trends and patterns in the market and can be used to make informed investment decisions. One advantage of technical analysis is that it can be used for both short-term and long-term analysis. Technical analysts can use different chart types and indicators for different time frames, from intraday analysis to long-term trend analysis. However, it is important to note that technical analysis is not a perfect approach and has some limitations. Technical analysts rely on historical data to make predictions about future performance, and there is no guarantee that past trends will repeat themselves in the future. Additionally, technical analysis cannot predict unexpected events, such as changes in government policies or major economic shifts that may impact a stock's performance. In conclusion, technical analysis is a popular approach that investors use to study market data and identify patterns that may indicate future price movements. While it has some limitations, technical analysis can be a valuable tool for investors looking to make informed investment decisions. By understanding the principles of technical analysis and using it in conjunction with other forms of analysis, investors can increase their chances of success in the stock market. Fundamental analysis is an approach that investors use to evaluate a company's financial health and determine whether it is a good investment opportunity. This involves analyzing a company's financial statements, including its balance sheet, income statement, and cash flow statement, to evaluate its earnings, assets, and liabilities. Fundamental analysts look at a variety of financial ratios and metrics to assess a company's financial health, including price-to-earnings ratio, P/E ratio, price-to-book ratio, P/B ratio, return on equity, ROE, and debt-to-equity ratio, DE ratio. These ratios help investors understand the company's profitability, valuation, and financial leverage. One advantage of fundamental analysis is that it provides a long-term perspective on a company's financial health. By analyzing a company's financial statements and metrics, investors can evaluate its potential for growth and identify potential risks. Fundamental analysis can also be used to compare companies within the same industry. By analyzing multiple companies' financial statements and metrics, investors can identify which companies are the most profitable and which are the best investment opportunities. However, it is important to note that fundamental analysis is not a perfect approach and has some limitations. Fundamental analysts rely on financial data to make predictions about a company's future performance, and unexpected events, such as changes in the economy or major shifts in the industry, can impact a company's performance. In conclusion, fundamental analysis is an important approach that investors use to evaluate a company's financial health and determine whether it is a good investment opportunity. By understanding the principles of fundamental analysis and using it in conjunction with other forms of analysis, investors can make informed investment decisions and increase their chances of success in the stock market. Investors should consider diversification when building their investment portfolio. Diversification involves spreading your investments across different asset classes, sectors, and regions to reduce risk and increase the potential for returns. One common way to diversify your portfolio is to invest in a variety of stocks across different sectors, such as technology, healthcare, and energy. By diversifying across sectors, investors can reduce their exposure to risks that are specific to one industry. For example, if an investor only invests in technology stocks, they may be at risk if there is a downturn in the technology industry. Investors can also diversify by investing in different asset classes, such as stocks, bonds, and real estate. Each asset class has its own risks and potential for returns, and by investing in a variety of asset classes, investors can reduce their overall risk and increase their potential for returns. Another way to diversify is to invest in different regions. By investing in stocks from different countries, investors can reduce their exposure to risks that are specific to one region, such as political instability or changes in currency exchange rates. It is important to note that diversification does not guarantee a profit or protect against loss. However, by spreading investments across different asset classes, sectors, and regions, investors can reduce their overall risk and increase their potential for returns. In conclusion, diversification is an important strategy that investors should consider when building their investment portfolio. By diversifying across different asset classes, sectors, and regions, investors can reduce their overall risk and increase their potential for returns. By understanding the principles of diversification and using it in conjunction with other forms of analysis, investors can make informed investment decisions and increase their chances of success in the stock market. Investors should consider risk management when making investment decisions. Risk management involves identifying potential risks and taking steps to limit potential losses. One way to manage risk is to use stop-loss orders. A stop-loss order is an order placed with a broker to sell a stock if it falls to a certain price. By setting a stop-loss order, investors can limit their potential losses if the stock price falls. Another way to manage risk is to diversify your portfolio, as discussed in point 9. By investing in a variety of stocks across different sectors, regions, and asset classes, investors can reduce their overall risk and limit potential losses. Investors can also use hedging strategies to manage risk. Hedging involves taking a position that offsets potential losses in another investment. For example, an investor who owns stocks in a certain industry may buy put options on an industry index to offset potential losses if the industry experiences a downturn. It is also important to consider your investment time horizon when managing risk. If you have a longer investment time horizon, you may be able to tolerate more risk than if you have a shorter time horizon. Additionally, investors should consider their own risk tolerance when making investment decisions. Some investors are more risk-averse than others and may prefer to invest in less risky assets, such as bonds or mutual funds. Thank you for your interest in this book. Please leave your feedback on these thoughts in the comments below, or just put a like on this video. It will help me stay motivated and make more videos like this. In the description of this video, you may find links where you can purchase this book.